Just as a quick reminder then, we've got this holding company, Marte, in a country called Marte with M dollars, buying a subsidiary. They're investing in this project for the subsidiary, and that's in a country called Elam with E dollars. Now, we've got to do the E dollar figures first, because then we've got to work out the tax on the E dollar figures, okay? That's what we're going to do in this video now. Then after that, we're going to translate everything to M dollars. And then we can finish off with any specific M dollar items. But let's go and have a look at the tax then based on the E dollars in Elam. So it says the tax allowable depreciation is given to me in E dollars. So that's great news. So just given to me, tax allowable depreciation. All shown as negatives because it's tax allowable depreciation. And he says in year 4, there's a balancing allowance of 2701. So minus 2701. And we're sorted. So what we can now work out, because it says that Pricer will pay tax at 20% in Elam on profits in that country. Okay. However, it will be exempt from tax in Elam for the first 2 years. So now we can work out what the tax rate is. So no tax in year 1, no tax in year 2. Tax here would be minus, because it's a cost, 20% of, in brackets, that plus that plus that plus. Okay, comes up with a gobbledygook, so get your numbers right. Want it to look like that. Okay, and once you've done that, you can just copy that across. No tax at all on the investment, just on that. Okay, so that's the tax allowable, or the tax that we would therefore then have to pay. So I can now work out what's remitted to or from Marte. So if you think about it, in year 0, yes, I would have to pay that. Talking about it from the parent's company point of view now. In year 1, definitely that. I'd have to pay the sales, or I'd have to receive the sales. I would receive the component costs. I'd pay them. I'd pay the other costs. I can ignore tax allowable depreciation because that's just part of working out my tax amount, okay? And my tax amount was 0. So I can ignore the tax allowable depreciation. That's just part of a calculation to work that out. So year 2, parent company would receive that. They would have to pay the component costs. They would have to pay the other costs. They could ignore the tax allowable depreciation because that was there just to sort out their tax bill, of which there wasn't any anyway. Year 3, it'd be that plus, so they would receive the sales, they would have to pay component costs, they would have to pay other costs, they would have to pay the tax bill. They could ignore everything else. And finally, in year 4 then, they would receive the sales, they would have to pay the component costs and the other costs. They would receive the money from the investment. They could ignore the tax allowable depreciation because that was just helping them work out the tax. Okay, and now we can exchange it. So it's just a case of taking that and dividing it by the exchange rate. In year 0, it was 2.6. Take that, and in year 1, the exchange rate was that. Take that. Year 2, the exchange rate was that. And you just carry on. Nice and straightforward. Lots of easy marks. Finally, year 4, use year 4's predicted exchange rate, and you're done.